Well, hello everyone. I'm John Nelson with M&A. I'm joined by Keith Prather of Armada, and welcome to this month's Economist Board, where we're going to talk about all the different economic conditions that are influencing our market. We have a lot of emphasis now on industrial production as well as the transportation sector. Take a look at the macro look on the economy. And we'll also take a look at the construction services and the supply chain. So uh, and that's with all of our videos. This first video that we share with everyone focuses just on a high level look at industrial production overall and its critical inputs from the perspective of metals. So we're going to dig deeper in the other sectors. So if you don't subscribe to the rest of them and you're enraptured and just absolutely captivated by Mutt and Jeff here talking about economics, please jump on and subscribe. So Keith, how are you doing? Are you ready to
No,
get going with this?
I'm doing fantastic. Yeah, absolutely. Ready to rock and roll. There's a lot happening out there in the marketplace. There's a lot happening in the economy. We've got the election coming up, Federal
Mm-hmm.
Reserve, possibly making a move in September. So there's a lot going on, a lot happening geopolitically, global supply chain, a lot of moving parts right now, which is why I love the models because models kind of help us cut through a lot of that noise and get right to the fundamentals and
Right.
kind of pick a way through it. So let's dive in.
Okay. So I got to be smart enough to be able to share the model. So that's always a challenge when you're asking me to be smart. So we're going to pop up the model. We got it up and we got to hit the share on the right screen. Here we go. Screen. Well, I said I was going to, and things just disappeared. Hold on a second. Let's try this.
We've only been doing these Zooms for what, 4 years now?
Yeah, and
Or
now, yeah, and that's not it.
good
You can
picture of
see
your
my,
family.
there's my
Good picture of
family,
your family. There's
everyone.
your
So let's
family.
try this one time. Well, I don't know what I did,
There you go. Beautiful
but
family.
there it is.
All right.
Yeah. So I don't know how I did that, but that's just one of the mysteries of being me on a Monday morning. So, which is when we're doing this. So, industrial production, the story remains similar, except that if you notice, and we've talked about this before, one of the reasons why you want to kind of pay attention to this a little bit on the monthly kind of gives you a feel for how the model is reacting, but a little bit of a flattening, if you will. It's not a big thing. Where we used to peak out around 103 by the end of the year into the beginning of the next. Now we're kind of below that. We're at the high 101, just before 102. But it is a little bit of a flattening, but overall not a big difference. It's still moving forward. Certainly not what you hear everybody talking about recession. And Keith, I wouldn't call that recession. But then as
Yeah,
we take a look at the long term,
I was gonna say,
there
what do you
we,
think? Let's go back for a second. What do you think about the
oh,
cone?
sure.
What do you think about the cone? Because we look at that downward side there, and I look at, we've talked before in the past about bias, and we're looking for whether the model's giving us an upward bias or a downward bias. And right
Mm-hmm.
now, I would say it feels a little more split. There's a little more downside risk here for manufacturing than what we would have normally seen, over the last 4 or 5 months, I think.
Yeah, and I think the way to, for viewers, the way to read this cone is whenever you do a forecast, you're saying, okay, our best guess is it's going to be right there on the orange line. And that cone says, all right, but I'm but so sure of that. On the outside, I think it could go as low as the yellow line. And on the bright side, I don't think it ever could go as high as the top yellow line. So that's kind of the way to look at it. And if you're looking at the bias, well, that cone is going to be equidistant on either side of the forecast. So you're right, Keith. It's lower, just like the orange line. The forecast is a little bit lower. The width is about the same. Um, when you if you think of it in terms of a bell curve, where is the probability? You're getting about the chances of it going outside of that curve, outside of that gold line is like 90, you're inside the gold dots is going to be over 90%, roughly. When you start getting closer and closer to the orange line, you have a higher and higher probability of that's where it's going to be. That's why we stake our accuracy based on that center orange line. So, if you kind of put like another band right around the orange line, that's where we really think it's going to be, maybe, a couple points above or below that. So, but you're right, you're seeing that a little bit more downward bias possibly.
Yeah.
But that's reflective of the whole thing moving with it, like a fan.
Right, right. And what I look at there is I look at the last month's model versus this month's model, and you see
Mm-hmm.
a little more negativity, as you said, or a little more flattening out. So we can call it flat. But as I think about members and I think about those who are listening to us, I think about business managers and how do you use this data? What are you looking at here? We were over the last couple months, we were seeing this positive upside that would tell you that maybe you need to hire, maybe you need to go ahead and keep, talent, maybe you need to continue to invest. Now what we're getting is a little bit of a cooling signal, and this cooling signal says maybe you need to proceed with a little more caution. And
Mm-hmm.
kind of see that in some of the national manufacturing surveys. So, like if you take the ISM's PMI or you take S&P Global's PMI, both of those are now showing manufacturing in contraction. So it's a deceleration in national manufacturing, and those measures, I can promise you, those measures are not any of the 18 to 20 different measures that we use in these models. Those are just indicators, reading the industry, reading surveys. What we're using here are those real nuts and bolts that move manufacturing up and down, create demand or create supply or push down on demand or push down on supply. And our metrics are now starting to send us similar signals of a flattening or more of a lackluster outlook. And so that's just the big headline story for me this month is just that we're getting these downward signals and they're kind of flying along with what we're hearing in some of the broader macroeconomic stuff. So
Mm-hmm.
I just want to get that out. And I know we normally
Yeah.
jump to the next slide to really do a lot of commentary, but I thought this one was kind of important. So
Okay. So, and here is the next slide. I think from my side, what I'm seeing is, yeah, you may have a little bit of that downward bias. You can actually see it as a little bit of a drop there on the kind of looks like that on the tail end, but it's still above that 20-year trend.
yeah.
Now, gosh, that 20-year trend is measuring pretty big swings in this case. So, where is that? Where would the 10-year trend line be? The 10-year trend line would be up a little bit higher, closer to the 100 mark. But still, we're above that trend, even looking forward.
Yeah, and so this chart, given us that long-term view, would say that yeah, you were exactly right. It's not recessionary at all. It's not sending us that signal. It is flattening out a little bit. And we know you've said this many times, but you look at the jagged pattern that you get with this model. We know historically the actual data is not going to be just a nice flat line like what we have in the model, right? So, we
Mm-hmm.
know that. We know it's going to be jagged, but the general direction here, looks like a fairly stable environment, even if it is kind of flattening out over the next quarter or two. And that's the signal we're getting. But then in 2025, maybe coincidental with, Fed loosening interest rates, maybe what we see, maybe a construction cycle that looks like it might be pretty good for 2025. And then this manufacturing demand starts to kick in. And that's where you get that nice little resumption of a peak, kind of late next year, or maybe by the second or third quarter of next year.
Mm-hmm. Okay. Well, where would you like to go with this one now from what we're talking about? Do you want to take a look at primary metals or
Yeah,
fabricated?
yeah. Let's go to whatever you have next in line.
Okay. Well,
I
either
think
either
it's
one's going to work. So
okay.
we'll
There we
start
go.
off with primary. So we're going to go all the way back to the source. We're at the mines now and into the foundries, really at the foundries. And now you are definitely starting to see a downward bias. Again, still kind of flat, but where we were flat at around 97-ish before, where you can see we're kind of riding underneath that 95 line or hugging the 95 line. And at the tail end, there's a little bit of tailing off. Same kind of thing that you saw there on the IPMAN model. But there is still a pretty big overall cone, so variability cone on this one. Anything off of this, or you want to go straight to long range?
Yeah, go ahead and go long range. Yeah, that'll work.
Okay, so long range now it makes that drop look a little bit more pronounced.
Yeah.
Um, Again, if you take a look at this, I always like looking at shapes and have we seen something like this before? And does it make sense? And so we're bouncing around the trend. If you look historically, you're all around that trend line. In fact, sometimes you're really way above the trend line. Some places significantly below the trend line, and we're still relatively tight within what our historical averages have been.
Yeah, it's kind of interesting. We had to do a commodity report for one of the big supply associations and then also a few construction clients. And what they're noticing is a drop in steel prices and a drop in, well, sort of a quasi drop in copper prices. Copper still remains pretty high, right? So we're still sitting like 2 to 3. Well, we're in the second or third highest price for copper environment that we've had historically.
Mm-hmm.
I didn't say that very well. That was a really clunky way to say that, we're still near all-time highs. But what's happened is we've got to change, John, on what's going on in the primary metal industry because China has historically gone in and purchased raw materials when prices are very low. And so not too long ago, they stockpiled copper when copper prices were a little bit lower. The manufacturing sector has been really challenged. It's been really sluggish. Their consumer economy is sluggish. And so to generate economic activity, what they do is they take some of those government subsidies, some of the government metals, and they'll pump those down into the manufacturing sector and they'll tell the manufacturers, just go build an intermediate product, go build these intermediate shapes and sizes and bars and all those components to stimulate manufacturing activity, to keep people employed, to prevent layoffs, to generate a little bit of activity. But typically they're doing that without having a buyer. They don't have a buyer on contract. So then what happened is we went through this production cycle where all of a sudden we get a lot of these intermediate copper products and then we see those get thrown on the global market as intermediate copper. And these intermediate copper then, other job shops will take it and form it into the, tubes or whatever they want to form it into, or wiring or whatever it goes into for final product assembly. And so we're going through a cycle like that right now where the market is suddenly being hit with a little bit of this excess commodity, excess metal, and as demand in construction and a little bit of the manufacturing softness we talked about a little bit earlier starts to play in, you start to get curves that look like this, where the model is going in and seeing some of these commodity prices dropping, it's seeing weakness on the demand side. And so even though we still see it playing out a little steadier in the next couple of quarters, that's why I think we're getting that tail end, a really big, sharp drop off in 2025. And
Mm-hmm.
you've said this many times, and you would counsel me on this. I know that we have a lot of confidence in that first 6 months of this curve, but the back end of it, the tail end of the curve is going to whip quite a bit based on what happens over the next couple months. That's why we do these monthly, because we want to be able to look at that and gauge whether the back end of the curve is flattening or whether it continues to give us a downward bias, which it is right now. When I look at if this model plays out, if you're in this industry and you do primary metals, you don't like what it's showing you right now because you're showing maybe the third weakest outcome historically for primary metal production. Um, that doesn't look good. That doesn't feel good.
Mm-hmm.
Between now, though, and middle of next year, you're looking at a curve that probably still beats the long-term trend um, before it then suddenly just falls off a cliff, is what it looks like and what it feels like. So and I think you would also tell me that this is one of the most volatile models that we have. I mean, the numbers itself, the actual figures itself, you can see how jagged and how volatile they are. So it's just an industry that does see a lot of peaks and valleys and a lot of strange cycles. But I think it's important for us to look at this curve and understand what's happening globally in this sector right now.
And I was going to ask you, you had talked about um, copper specifically and metal specifically, but one of the journal articles that I just recently read talked about the possibility of some Chinese dumping of steel back into the market.
Yeah.
Are you seeing that on from your end?
We are, yeah. A lot of producer prices that we look at, which kind of gauges the prices for these commodity metals, has been diving. So we're seeing softness, we're seeing weakness in those prices as well. And there's a little bit of, there's some trendy stuff happening, like a lot of automotive manufacturing now is including a lot of aluminum, a lot of different types of base metals. And so, you historically, like if you look at this long-term trend, you can see that this change and the types of metals that we're moving and making, and the fact that we're sourcing a lot of that internationally is probably impacting a little bit of U.S. industrial production of primary metals on a long-term basis, right? We see less of it onshore and probably more of it offshore. And so that's part of this trend. But yeah, I mean, overall, when you start to see a slowing in some non-residential construction and even some of the infrastructure bill, if you see a little bit of, fits and starts there, that's going to change demand for steel. And then you throw more supply on top of that, and obviously that's going to push things down.
Hmm.
I think the big questions here before we move on is, how long does this hold? Because there's only a finite amount of that excess Chinese copper supply, for instance. And we'll work through that supply, and then we get right back into a new cycle where, we still have challenges with copper production at a mining level. You won't have stockpiled Chinese copper, feeding into the manufacturing sector. So we're going to get back into a cycle where copper prices are going to go back up. And again, they've softened and come off their peak, but they're still historically at high levels. So I think this is an intermediate kind of situation. And I think the model may be anticipating or reading a little bit of that because you see early in 2025, like Q1, Q2, which is what I'm thinking of, you do see a surge in prices for primary metals. And I think that's some of the inventory cycle and working through some of that inventory and then getting back into a brand new production cycle. And and that's what I think the curve is showing us.
Okay. Well, let's take a look at something awfully related, the fabricated metal.
Yeah.
And now this is this is kind of curious because it's going the other direction. But one thing that's interesting about the model this month is take a look at all of a sudden for the next few months, all the way out to January, it said, nah, we're not going to accelerate. We're going to start to, we have this scoop almost of softening, and then we're going to accelerate. So, uh, frankly, I didn't know what to make of it. If you at first glance, it looks awfully similar to the other one. It ends up at about the same spot, but that softening for the next few months kind of threw me a little bit.
Yeah, and this industry is driven directly by all the other industries that we watch. So automotive, machinery, aerospace, and that's what's going to drive production in these
Mhm.
industries. And we still have a little bit of sluggishness, like in the machinery sector, right? Transportation, machinery production has not really taken off the way we thought it would. We're not getting that rebound in ag equipment and construction sluggish. So, some of that soft near-term demand is showing up here, and I can find corroboration in the broader economy in those industries that would drive demand here to say that, yeah, the next 6 months should be a little bit weaker. But then I think you get the Federal Reserve interest rate cuts. You start to see a little bit of a rebound in automotive sales. We get a little bit of a rebound in ag machinery production. Aerospace is catching up. And so the back end of this curve, starting in 2025 and seeing this really good, strong growth curve, absolutely makes a little bit of sense right now. And from what we see in the real world and not just in the data world, right?
Right.
I guess they both are the real world, but
Yeah. Yeah. All right. And so let's
let's look
take
at
a
the
look.
long term. Yeah.
Yeah, the long term. Let me see if I can get. Anyway, click the wrong button there. Okay.
There you go.
So long
Yeah.
term, yeah, see that little loop that we were talking about. Almost for those of you who are in the manufacturing, you're not going to think that's significant, but in the long term, it looks insignificant. And now you almost have that case where you have the Nessie thing sitting out there. The outlook is so positive, it almost looks like the Loch Ness monster coming up, sticking its head up, going forward. Uh, and I look at the curve and I think, is this realistic? And there's going back that kind of a curve or moving forward. is indicative of what we saw not only coming out of COVID, but what we saw in 2017 to 18, what we saw at the end of 2012 and 13, what we saw all the way back to '06 to '07. So that kind of growth is not out of line. So I don't see any reason to doubt the model. What's nice looking at the models to see how far above trend it is.
Yeah,
In fact, they
absolutely.
maybe resetting the trend, even if you were to look at it from a 10-year trend point, it almost looks like we're going to start setting the trend here.
Yeah. You and I talked a lot about that 2014 to 2016, 17, 18 cycle. And it was unique because when we look at inventory to sales ratios across the board, in 2014, we saw inventory to sales ratio surge and it shut off a big portion of the manufacturing supply chain. And that's why we get this dip, this dive, because everyone was just feeding off of existing inventories. No one was making anything new. So assembly lines started to get sluggish. Transportation and the global freight industry went into a secular recession. And then as we came back out, you get this, the minute inventory's bottomed, all of a sudden we get this really sharp response. And that's why 2017 and 2018, you get this really dramatic increase coming back out of that. But we just went through exactly the same cycle. So starting in 2022, we had exactly the same inventory to sales ratio surge and spike, and we've been through about 18 months of a transportation recession. And now we're starting to see those inventory to sales ratios get more balanced, and they're coming out of that unbalanced period. And so we are expecting maybe that we get this surge. Now, I don't know that that's what the model is reading, but historically, like as you said, there's precedent for it, and we can tie some of those peaks prior to some of that. The other peak would have been coming off of cash for clunkers and trying to
Mm-hmm.
stimulate automotive demand, and that would have definitely impacted fabricated metals. So,
Okay. Well, that concludes our look at the overall industrial production manufacturing piece. So I hope you enjoyed it. I hope it was informative for you, and join us again next month.
very good. Thanks, everybody. Bye bye.